Hi. So that was that's probably one of the most unexpected prints that we've seen for ages there on non-farm payrolls. Just about every metric opposite to consensus. There were people being laughed at for being positive. But as I mentioned this morning, it looked pretty much like equities were going to like the majority of outcomes. Bond market's going to sulk. Dollar's obviously slightly strong, putting in a double correction at the very least. If not, we might have to think about whether we're actually done for the move, but we'll look at that. Gold obviously smashed down instantly on the perceived lack of rate cuts, but I think you've got to keep it in context that the 3-week average is something like 186. It's 3-month average for non-farm payrolls. So that's only kind of bobbing along at an averagely good clip. It's not super crazy, and that 254,000 wasn't crazy. It's only bigger than the individual prints, and everyone went in so negative. So don't get panicky that they're going to start reversing engines on inflation, but it does make this week's CPI quite important, doesn't it? Because you don't want a week where inflation pops at the same time that you've seen extra perceived growth coming through. But net equities love those outcomes. I think, as we've been saying, we've been looking to try and stay long or buy any dips that you see, and that is perfect outcome. You've got growth, you've got people, by the look of it, actually employing people, you've got demand for jobs, people joining the labour force. We'll look at those figures in a minute. But when you come to dividing by an interest rate for discounting versus economy growing, the economy growing wins. That's why I always push you to that horse. Growth trumps everything. So this is good news going into Q3 earnings. That the backdrop is totally pulling the rug under the recession for the moment. So to me, indices win short term, and obviously the reaction has gone that way so far. We've not had any real pushback. Now I've mentioned a couple of times this week, Gamma has dropped out of the system. That's options expiring, etc. At the end of the quarter. They may start coming back on, but at the moment, the net effect on market makers and dealers is that they don't have to hedge as much. And so they weren't necessarily standing in the way to buy it, and they've got no reason to stand in the way on the upside, particularly. And with results like that, they're more than likely getting taken out of deltas. So if anything, the market is likely to chase up if volumes come in. So it works both ways, I'm afraid, on that. So hi Bletchley, good to see you there. And Sleeping Rains, good afternoon. What are you guys thinking? Are you totally shocked, don't know what to do, or did you have a plan going in? I mean, so just looking at the household data report, the one that I always like to look at, you can see the civilian population obviously grows. You've got positive birth rate, etc. The labour force has been going up. Look, that even went up another 150 people joining the labour force, whether to take a job or they think they've got a chance of taking it. The key thing that's happened here is something that doesn't happen very often, is that the number of unemployed went up 430 and the unemployed fell at the same time. So that took us to 6.834 million divided by 168,699. That comes out at 4.051, which rounds up to 4.1. So it's as close as it could have been to not being 4. That could easily have marked at 4%, and then you'd have had even more wild panic for the bond market. You were looking for NASDAQ. I mean, yeah, I would stick with that for a minute. It's been toying with 20,000 on NASDAQ 100, and it took 20,000 out on the future earlier, which has been a big resistance level. I think we've had people standing in the way on this. We need to make, and it could retrace intraday. We'll see what it was like when it opens, because you often get those late orders. But if it does pull back, I think we'll see money come flying in. We've got tech earnings particularly showing positivity, and we've now got the growth backdrop. It's more than likely they're still going to cut 25 basis points in November unless they get another hottish report just before for next month. So I think going through the earnings season, and so far the techs have been good, I think it's going to have a backdrop of pushing on. People will be aware of that. I think you'll start to see that rotation back into the large growth stocks. So I would stick with the Nasdaq breakout because that's how it looked to me on the chart. It's a 50-50 going into this. It's been a consolidation week as to whether it's going to roll over or break out. Obviously, it needs to break out, but I think we've got the backdrop for it now. We will look at that. So yeah, the only other key thing, the couple of things on other bits. I never look at this home-based data, but apparently that did give better trade ideas. Bless us with some giveaway accounts. Sorry, I still haven't got that sorted. Alex has not been available. Yeah, this home-based stuff, some Bloomberg guys were looking at it, and that did suggest there was going to be a strong report. That'll probably now be watched every month and not suggest anything. The big surprise to me was that July didn't stay where it was or got an actual further downgrade. August normally, seasonally, does see an upward revision, but it was the July print that has caught everyone out within that setup, which may get more airtime as the day progresses. And it was pretty much across the board. I know most people are going to say, can we trust this data? Because so far it's been the one that's had the biggest seasonal revision, and it's had revisions most months negatively. So we need to see the sequence of better data. It doesn't revise. So it's big point going into next month. Not only is it going to be another strong one, but will this data today hold, and will that August revision hold on second reading? But for now, we'll take it as the market is looking for a theme to get long seasonally in the second half of October through the election into the end of the year, and this may well just bring that forward. Bletchley, what were you saying there? There's a lot of adjustments made last week by the US. What's that in rotation terms, or? I mean, if anything, what a lot of people are concerned about is that it's been opposite to most of the things we've seen this week. Sort of job in jolts, the quits rate was low, which normally means there aren't other jobs to go to. The opportunities got revised up, but the number per head of job seekers was trending down, and that was on August data. That may well come through as something that just causes a revision next month to the August data. Because remember, jolts is always a month behind. But then the manufacturing employment was really weak. The ISM services was fairly weak on both reports, the S&P Global and the ISM one. So this was a bit of a surprise. We expected some strength from ADP given its current directional bias being correct, but net overall to see across the board job rises is slightly suspicious, but we'll take it for now. Yeah, I'm not totally convinced about today's data, but given how much credence people give it, we'll go with its effect for the minute. But actually, I'd like to see how people react into next week. But I do think it opens up. If you're on the fence about whether to be invested for the Q4 rally, you're going to be opening the spigot now, I think. What we need to do is focus on just how much the dollar unwinds. I think they are still in a cutting profile. What it means is that it's not just going to be focused on jobs, which is what they said at the minutes. The summary of economic projections had said inflation's controlled. We're now worried about jobs. This now goes, well, what are you worried about jobs for? So it's a case of, will inflation still behave? So the big thing for CPI is that we had a rent increase last month in the calculation, and the house prices have been up despite other indices not necessarily showing any strength. So you never know, we might get the combination of 6-month data that goes into that suddenly showing up as being the weak ones, in which case it's full steam ahead for the Fed's rate cutting still. They want to normalise to a degree. This sort of reintroduces 2.5% to 3% as being the sort of normal rate. Even so, even at 5%, they're still looking at real rates of 2%. They probably, in normal circumstances, only want to be 1% ahead. It's just a case of how loose are financial conditions out there. You've got to feel they're quite loose. People have taken the bond market, the forward rates, as far as they possibly could into this, so people can borrow. There's been mortgage changes already. People have been applying heavily for those. So it's in the system. There's going to be a slight bit of pushback from overbought bond market conditions, but net, the interest rate market has done the job for the Fed. They don't even have to cut the rates necessarily. But we do I think the consensus will just stick at 25, and it'd be an oddity for them not to follow through given what they said at the last meeting. But there's no chance of 50 unless you suddenly saw a bigger revision and more at the next non-farm payrolls. What I wanted to look at was those PMIs just in general, because they were showing some weakness, really. So that was everybody's updates, manufacturing and services this week, including the ISMs. Now, the China composite actually went up, despite the fact that manufacturing only jumped. It was still in contractionary and services at 50. The composite is made up of their actual manufacturing output and their business activity. So it's given those two numbers, they don't directly add up to what the composite number is. That's why the composite is strong, because the manufacturing output is something like 52 in the manufacturing side. That's just a nuance, but it's saying that that Chinese national data is a correct, strong print. But the one that's normally correct is the Caxin one, which is the privately done one, and everything was in retracement there, which is one more to be followed, and the reason why they are properly stimulating. Even India has dropped well back below the 60 it's been running at for most of the year. Aussie manufacturing struggling, services a little pullback. Maybe that helps. They have been. Bullock is determined that they're not going to cut rates at all. Having seen what's happened in the States, she'll stand by some kind of global uptick, but they are slightly slowing down. PSA, don't know how to say names. So when are you going to tell everyone that FCA is investigating you lot? They're investigating us. That's news to me. We're always in conversations with the regulators because we are trying to go through some regulation. But nice for you to be spreading the filth again. Do you normally live on X? Have you got anything to talk about regarding markets, or are you just here to spoil? Anyway, we'll concentrate on people that are genuinely interested in getting better in the markets. Obviously, Spain has had the uplift, and that came through again with the construction data today. Italy struggling, but if you think, even though these were beating consensus, look, they're all in deep contraction for manufacturing, and the services again was slight mix. The overall Eurozone composite is still in contraction despite beating consensus slightly. UK has had a little bit of a fillip on the services side. Hopefully that comes through in next week's CPI data, and the index of services part of all that is what we're looking at. That's as that eases back, that's what gives Powell the incentive to be as aggressive as he was yesterday. Interesting pill came out today, the hawk, to try and slow him down a little bit, saying that we're going to go gradual, but net, when push comes to shove, pill will go with Bailey. can see in the ISM services yesterday, this is why it was a shock to see that today, that both employments have been falling back and are contractionary. So, and from the sideline comments that are normally reliable from that was that people were holding off on their hiring. So there may well be a lot of seasonal element to today's move, which we see worked back out of the numbers by next month. That again was possibly overstated. The ISM prices on the services, because there'd been very little activity the month before, for people to suddenly be doing a bit of activity, slightly more upbeat, by definition, they're going to be seeing higher prices than the month before. I don't think that is necessarily predictive at the moment. It'd have to be 3 or 4 consecutive big growths for that to be factoring in a big change to factory gate prices or service prices. NB Trades, tell us about ACG. We'd like to buy some accounts. What do you mean? I mean, I'm here to talk about the markets. If you want to go and buy accounts, I'd advise you to give futures a try. I think that's absolutely brilliant platform. It's been set up by Ben, who is a live funded futures trader. Everything is for the benefit of the trader, and it's designed to keep you in a calm way of trading and practice, not blow up, totally reward you for trading properly. So that would be a great place to start. You pay a monthly subscription rather than a one-off fee, and you've only got one phase to pass. So I would give that a great deal of your time if you're interested. Anyway, Sar, this isn't really the place for you to be moaning. It might be good for you venting some frustration, but you need to go and speak to whoever it is that's dealt with you. I have nothing to do with managing the accounts. So do me a favor and desist from doing that, or I will just ban you, and I don't want to do that. Very happy to answer any questions you might have about markets, but I'm not the platform for any account issues. I can't even access the system myself. So fallout, gold has obviously pulled back. We're now having a bit of a, thank you, sir. The gold down into the sub 40 region now, having a little bit of a bounce back. I said earlier in the week, I redrew this for the most positive outcome we could possibly have. Since I last posted a chart on Monday, I've just adjusted that to what is a more healthy 2-3-4 channel for this fisher thing into Monday evening's low. That has now become a key test level as to whether this whole thing becomes a double extension in itself. So that gives you 26.24. There's a kind of stop loss for the buys, but we're now back into the 26.48 area. As it is, with that becoming the new 4 low, subwave 4 low. Remember I talked about the wave 1 equaling wave 5 for actually, can you see that? You can't see that. Here it is, the gold chart, hopefully. Yeah. So what I'm saying here, we previously had this black channel for the minuet waves. It was quite narrow. It was where the halfway part of the channel is now, really. We did a double extension in the first instance. So I've moved it there as being the extreme. That gives us 26.24 as a stop loss for the current setup. Within that, I'd said this wave, red wave 1 to equal 5, which was currently going up there to 27.80. That now, interestingly, puts a top exactly where the wave 3 spot 618 Fib finishes, which is 27.63, spot 4.4. We've got an absolute overlapping confluence there, and that would be a little overthrow of the channel, or it be right at the top of the channel if it takes a week or so to get there. So we'll keep that in mind still. Just confirms a little bit more that 27.60 level, maybe the resistance part. So let's say this could be a three-wave connector and then another three-wave down. And what does that look like? That should hopefully line up with the 26.24 as well. So yeah, so maybe a break of that 26.18 is the equal legs. Maybe even an overthrow to 26, but I wouldn't give up necessarily yet on gold. There is potential for this to be the top. We could subdivide and bring that 3 back down where we originally had it and have this top as a wave 5. It is kind of mid-range on its long-term parallel channel. It is an overthrow on what was the previous 2, 3, 4 minuet channel. We're in the sub-minuet ones at the moment, the red ones. So it's still in that, what we had is the circle previously, if you remember. There's the ballpark somewhere around here. So that's alternate 2 that we could be there and then looking to do a proper pullback into 2500s. But for now, we need to see how it reacts from here and if it does put in a challenge to that current wave 4. At the moment, it's dug in. I mean, I'd imagine that some people are going to try and anticipate that inflation has a chance of coming back in with the fact that we've got the strong growth. Like, so what's the read-through going to be for CPI this week? Have the Fed got it wrong? Remember, in terms of inflation and gold, it's not necessarily the CPI inflations, it's the monetary inflation. They've started easing rates. We've got money supply moving again. We've got growth still in the system. We've got job growth. So that's where it's that implied inflationary debasement is what we should be looking at. So it's policy mistake. Hard landing is what gold's best case is. We talked about that a few months ago. So if the market were to try and interpret that, if they're more likely to be next putting rates up rather than still cutting, then gold probably still outperforms net. Yanta Chiroma, downwater chart. Well, it's just one chart way of looking at overlapping parallel channels and fibs for some confluences. You don't necessarily need to have the fair gaps and stuff written all over it because this predicts where the likely turning points are. We know that it's powerful when it does line up with previous support zones, like you can see on the way up. So that was a wave 4 of a wave 4 at lower levels, lining up with a high degree wave 4. That's going to be a powerful, strong support, which is why I'm interested in it. Dollar-wise, we were talking about, could it break out of that channel that we were in, the contracting one? And we did suggest that on the daily chart, there was a potential for 102 to 102.5, which we've now hit. We've got to decide whether, is that the first leg of 5 up that retraces and then goes on to further highs? This lower low over here, is that the end of the whole move down? I suspect it isn't. We allowed for the fact that we could have a bounce up. If you look at where we were on the daily, I was looking at this earlier before non-farm payrolls and decided not to move it just because the implied movements are how we've played out. It's just the gradient due to the days. So we're expecting this overall move to come down to this region. What we've got to decide with now is whether the subwaves have made part of that is this actually the end of the wave 3? In which case we're doing the wave 4 or the 1 degree higher. And we just have to see how that plays out. If the higher the degree, the more likely, the bigger relative the move back. I'd anticipate there being a little bit of flip-flop on this whole dollar situation. But at the moment, it is looking like we could be overall heading for a challenge up into that 105 region eventually. So I'd lean towards making this whole thing the wave 3. My thoughts at the start of the week were that we'd only gone to the lower degree 3 here. So we had 2 or 3 more short-term lows to play with. For the moment, it looks like we're going to be in a bit of a consolidation. It's data quiet until CPI in the middle of next week. Now, it's not impossible to have inflows into risk assets like we talked about for equities, even if you've got dollar positivity. It isn't a one-for-one correlation for that. We talked about the kind of dollar smile stuff in the past, but I don't think we've totally bottomed out yet. I'm only considering that to be the minor wave 3 red, in which case when this rally finishes, whether this ends up being the whole rally or whether it does a double, there is one more low at least to come before we put in this significant wave 4 low. Increasing now, I talked about the risk to the dollar downside in Monday's preview was the fact that the bond curve was so ahead of itself, and the risk was more that it would have to retrace a little bit. That would bring in some form of dollar consolidation upside for the dollar. It would make this pattern all start to overlap a little bit, which is what you normally get when you're in ending diagonal type scenarios, in which case it meant that 98 was going to be, at the very least, a stopping point short term, and it might end up being the ultimate finishing point, subject to what it looks like going into the November elections, because at the moment no one's really talking about fiscal policy being reined in. So there's going to be that commentary about is there an inflation mistake to come and a stronger dollar post the election, but we'll deal with that when we get there. But for the moment, we're still on that path. It's all about the strength of this bounce, and obviously we've seen it's quite an impulsive bounce this week, and that could easily spend the next few days maybe consolidating that, but there's potential for it to go higher. We'll have to look at that. We'll have to judge that more by the lower time frame, really. And if anything, if we look at it on the hourly, the way that is has been nesting the 1s and 2s and a lower low, we might end up even just bringing the 1 low across and making this whole consolidation 2, or even just bringing that over. It could be part of an ABC, an A up to there. The new lower low could be an overlapping, expanding flat, in which case we're working our way towards an ABC of 5 waves, which case that could finish fairly soon. So well, I'd like to hear what Williams had to say, and we've got Gouldsby coming up pretty soon. They're one, sort of left of centre in terms of dovishness and super dove. So that Gouldsby will be very interesting. He's having an interview on Bloomberg. Look out for what he's got to say about the net of the mix, and I'm sure they'll be intimating that it's just one data point, and they need to see that at the November print just to make sure that they're dealing with a trend rather than an aberration. Jan to Chiroma, book suggestions to read more about the waves patterns. Yeah, I mean you can go to find Robert Prechter and Elliott Waves, or just try Elliott Wave Forecast, Elliott Wave International. They've got lots of good resources there that talk about how things have developed, and there are some newer people out there that look at the wave concept and overlay it a little bit with fair value gaps and order blocks, so that there's a bit more of an overlap with how a lot of you look at ICT principles and smart money concepts, etc. But I think it's quite powerful because it gives you a chance to set up 2 or 3 options so that you're ready to react. Boom, boom, boom. Right, what else should we have a look at? Got any other? I know the US is opening. You got any other standout questions about the week or what's happened today? I don't really want to keep you too long today because it's going to be a good trading session. So that I was looking at EU again before we started, and we obviously had the new a new setup on the verge of happening. We were really challenging that, so I think there's a very good chance that if anything, we've extended across and done a double rather than it being super disastrous yet in terms of EU strength. There's still a lot of dithering going on in the EU about cutting rates. The fact that the US have had a strong uptick today, they may use that as a reason overall not to cut again in October. They've been looking for an excuse not to, despite the fact that Lagarde's been hinting that they are looking at the data. Data hasn't been wonderful. But if the US isn't going to go super crazy, then they can afford to wait. I think they may wait to see what happens in November, in which case this is getting close to bottoming out. This is just extended rather than the eking out of a very small high over here being, it doesn't really suit for that being a breakout wave 3. It could well be a wave. No, it wouldn't. We're extending because we've got a new low over here. So I think we've got a double extension going on, which is suggesting that we've got a rally to come again. So if the dollar suddenly calms down and people start factoring in that the short-term euro cut isn't happening, then we can start rallying again. I think that is what we're looking for. So I'm looking for potential buy opportunities in this EU as it settles down, because that very much looks like the potential for a 1 down, a consolidation, 3 down. And it's whether this is 4 and 5 or whether today's low is 3, another sort of test of that low and potential lower low, which we're looking to buy. So for the minute, keep your eye on the EU for potential breakout. GU again, that is holding on to its 1-2 breakouts for the minute, but has that changed the picture today? It's interesting. Obviously, we've got Pill talking G back up. U is obviously backing back up. What is the net? Again, the UK have got the October budget to get out of the way before the next rate meeting. Will that have any effect on whether they've got room to cut? Again, until this low breaks, and again, it might just be an extension. I still lean on the fact that GU has the potential for being the strongest of the European currency blocks, really. And there's not a lot really changed. Bailey is trying his best to help the economy and talk it down. But while now that there's confusion back in the whole picture, and the makeup of the external members of the Monetary Policy Committee, I think they will argue enough for them to wait until November. UJ is the one where everybody's falling over themselves to back up UJ. Ishiba chatting today saying that he and Ueda are on the same page. They will follow the data. They will stick to rate rises, but it's not a foregone conclusion that will happen by December. But if it doesn't, there's more likely that the economy picks up pace on a global rally like into next year, in which case, if they don't do it in December, they'll probably go bigger subsequently. So I don't think it's a case of them doing nothing at all. It's just a case of the pace of momentum to the Japanese economy. We were talking midweek about this being a consolidation, and would it put in a strengthening one that would ultimately lead to a double, or is it just the fact that we'd rallied enough to the 146 level to be enough? This looks like a clear 5 waves there for now. We're expecting a 3-wave pullback, and it may be just the part of a zigzag, so 5, 3, 5, just to ultimately hit that above 1-for-1 region that we talked about on Monday. But at the moment, it's done enough to be valid for the sell-off to start. So sharpen the pencils. Let's be looking for this dollar rally to fizzle out at some point, and we will be resuming that kind of UJ down scenario. But it's like we said on Monday, it was going to be the mix of data and the pace of it. So rather than this all happening short term, we're talking into the gradient changes. Because now the chances of 50 basis points in quick succession is almost done. So that means that equalization of rates, you've always got to think about the relative movement of rates with the FX. The US rate cutting slowing, even though the Japanese one is slowing. That was only going to be 25 basis points for Japan. The US one was anywhere between 50 and 100 by the end of the year. And it looks like everyone right now would be happy to take 2 more 25s, I think. So it's just putting in a little bit of choppiness. So it may well be that we get a 535. Thinking about it fundamentally, there'll be a bit of choppiness, maybe a little more of a realization that we aren't going at a quick pace, just to ultimately get that back in before post-election. We'll see how things develop. So yeah, so I'm thinking more over here now. What's good about that is that takes out another risk for the equity market. That's going to bring volatility down, means that the carry trade unwind, if anything, is possibly going to go back on. All those vol players, if VIX now drops back to 16 again, currency vol will be falling, then you'll start seeing, making it look like it's safe to come back to play in the water. Again, Nikkei is playing out as we thought, but I would caution that 3-wave down, which gave us 37,300. Have that as a stop loss for for the bull case, because this could just be a connector before it comes down to this 1-for-1 leg. That would be now, if we move that to there. Yeah, that brings $37,000 would be now an equal legs extended correction in the Nikkei. So I'd be expecting more likely a new high. If anything, let's use the 50-day or 50 period moving average for your support, which is around 38,500 if you're playing. So you've got 2.5% stop loss there for the swing traders. For some reason that's dropped off again. Sorry. You're not shouting at me when it's disappearing. Sorry about that. So yeah, here we go. The extended, if that were to become a 3-wave consolidation for this wave 4, which at the moment we've got there, could easily still end up being, oops, something like that. But for now, I think with the potential for equity rallies in the growth trumps everything scenario, let's use this support zone in here and the moving average, 50 period moving average, as the near-term stop loss. Excuse me, got a frog in my throat. So Germany, it very much looks like we had 2 lots of 3 waves and then a 5-wave move down to the low. So I've labeled that as WXY today. It's almost a 1-for-1, and we've been rallying. Edward on my chat, who plays this, had identified another one of his mermaid tail breakouts as well from sort of 19,040 in here this morning. He'll be very pleased he's got that breakout. And that does look like, for me, we're going to be putting in another high for Germany pretty soon. So that is one to play on any of the pullbacks we get. It came and bounced off the 50 period during non-farm payrolls. So we're looking in here, sub 19,000 again for stop loss. If anything, it's where the bodies really are. That's those wicks are quite annoying, aren't they, at times? So have that as your zone of fear, really. But if anything, I'm looking for continued breakout here over the next few sessions. And NASDAQ, lots and lots of people who are super bearish, and it's the end of the world in the Elliott wave tech world, are looking at this from the August the 5th lows as being a 3-wave high, which is now rolling over to the downside. But it's a 2-way pull for the moment. It's very difficult to prove that that's the case until really the consolidation wave 2, primary wave 2 gives away here, which is 18,300. At the moment, it's still living in the nesting scenario. I've not adjusted that for putting in a new high at the end of last week. So 1, 2, and then if anything, potentially we've had a very early 1, 2 in that pattern that held. Wave 2s can often be anything up to 99% in the early stages in subwaves, particularly. And then again here we're doing a series of lower level thrusts up, 1, 2s into breakout until suddenly when the big wave 3s come, we get breakout. So we're in that zone. I've been saying it all week. We've been running into risk off flows. It's quite a big scenario here. So short term have 19,650 maybe as a sort of stop loss. If this is going to go down, it needs to take out these lows in pretty swift order. Otherwise, if we put in a new higher high for this move, which is now 20,340, that will confirm a proper breakout, which takes us back to the original idea of what we've been talking about for Q4, is that we've got sub breakout of wave 3s within wave 3s, which is why you can often get a lot of movement. I think the tech indices are set up from an earnings perspective to outperform. There's been a lot of rotation out of them just at potentially the wrong time. Growth trumps everything in the scenario that we've got. We're still going to be getting rate cuts at a slower rate, with them showing a higher percentage of growth outperformance. It's a perfect scenario for the growth stocks. So I'm anticipating still sticking with that channel. 22,000 is the place before we get a proper pullback. At the moment, I've only drawn that in for the pullback just because you've got to have another high, and really it's going to be somewhere of the magnitude for wave 1 equals wave 5. So that would be what, 17.2 to 19.9, 2,700 to the. So we could get a pullback. It's all valid that when that comes, that could even be a decent pullback now. It's just more because we've got the end of season rally. I'm anticipating that to be a slow or a muted pullback around election time, that then when everybody gets calm and they know what the outlook is, that's when you get the seasonal end of Q4 rally, and you tend to get them particularly in presidential years. So net I anticipate a bit of a surge coming up to the election, a little bit of nerves going into it, and then the final leg afterwards. So that is my basic setup. But again, until we take out and put in higher highs, we have to be careful that the alternative scenario is still in play. It's becoming quite frustrating the way that we're not getting the impulse holding, but we've had to go through a tough week of data, a tough week of geopolitics, and the road could be open for next week if Iran don't do anything, if they're waiting for what Israel's response is. If Israel just keeps them waiting, that whole geopolitics risk off fades and we're going into earnings season, then this is the likely path going forward. Similar scenario with the S&P. So far, it's got two distinct impulsive waves up. You'd expect there to be at least one more high to make that 5. Some people are interpreting that as 1, 3, and that the 26th of September is the end of the rally and the last all-time high. But the substructure of that isn't as tidy as what everyone would like to see. Let's see how we go. But how many have we had now? 40 plus all-time highs. It's got the feeling that we're going to get another one pretty soon, in which case we're then looking for another 5 waves up in total. Where does that take us to? I still think Dr. 6,000 is going to be touched before we turn that off. Sorry, that once again hadn't changed over. So here we're looking. We had the sell-off there, which was a 3-wave into August. That was a definite 3-4, and then we're dealing with the 5th wave. We are coming towards the end of that pattern that we've talked about since April of a 3-4-5. We're just in the 5th wave of that at the higher level, which we've got on a different chart. So we're eking towards 6,000, 3-4-5. Remember, even though we're still at a peak, that's come off during the week as we've had a bit of risk off. The number of stocks above 50-day moving average have ticked back from 80 back to sort of 70, 75. 200-day, again, that's been lowering down to sort of 56%. So we haven't even had, we haven't had a real sell-off, even with the momentum just waning a little. So that to me looks like an excusable 3-wave pullback, and we've got the potential for the last breakout. And do we touch 6,000? The Dow has held on to its 1-2 without any adjustments so far, and it's been playing out relative to the sort of our guidance that we'd put in there. Again, we're just eking our way up. I still think 43,000, a pause, and then it's just how big we get the final leg up. Does it hit that 45,000 that some people have been talking about? Or will it just be another final all-time high in the 43,000s? But for the minute, it does look like we're going to be resuming that. My FTSE idea was that, and it may well start to play out now, if we've got growth and jobs and stimulus everywhere, then people will start focusing on that miners and growth stock idea. We've also got the energy complex, which are heavyweights in the UK index. So you're going to have two of the biggest heavyweight sectors in positive for a while, and they're dollar earners as well. So the strong dollar helps. So I wouldn't put off seeing this new breakout, all-time highs and eking up. If you remember months back, we were talking about 9,000 with Moisey potential going into the end of the year. That would be probably only possible if we really get the global rally on, but don't rule it out. But for now, let's be looking for the new higher high for the current move. It's again another sequence of nesting 1-2s, 1-2s. The current stop loss is 8,200 really. So you've got a percent to play with there before that. And then it'll have to take out 81.60 to make it an extended pullback. But again, as we said before, when you've got these setups, in fact, that did have a further breakout. I'll leave that where it is for the minute because that could be an expanded flat where you get that. You can have a new high without it being necessarily the previous high. That does look better as 5 waves to that top there. So that is what they call it. It's a kind of bluffing scenario in the terms of Elliott wave. You get an extension past the previous high or low. It's very much a 3-wave move there. I'm looking for, that FTSE looks like it is building for a nice breakout. Be careful of taking that on. This is an interesting one, isn't it? What does the oil bounce back look like? So it's very much done more than 1 for 1. It's right in the middle of that zone where we'd like to see it potentially changing. You have to take out 80.5 to suggest that we're in a proper bullish market. That may happen with some further escalation to geopolitics. So keep an eye on 80.5 really as being the potential defining moment. But we're really dealing with the sell-off post 80, 87.5, 88 zone that we talked about. We've since been in very impulsive sell-offs that were nesting right until this is suggesting that we have finished a move down there, in which case we're in a consolidation. We've either put in the whole of the 5 minor waves and that we're doing a wave 2 deep retracement, or this is very much now an overlapping 5 waves to start with, in which case there's one more low to come. If that's just a wave 3 there, and we've got a deep overlapping wave 4, there's a wave 5 to come, and then we'd have a decent rally. Either way, it's suggesting that there's a lot of volatility ahead still in oil, which the economic backdrop and the geopolitics is strongly suggesting. So if you're going to short it, have 80.5 as your stop loss on Brent, because that could suddenly be something a lot more impulsive if we're not careful. Bond market volatility, where were we talking about this? That is on a weekly basis. So we had it like that to show you the extremes of where it's been on a daily basis. We've been stuck in this channel with what's going on with the rates. Certainly I expect to see this maybe to do the double extension on the current legs. That's gone from 89 to 101 back there. So again, maybe 115 might even challenge this downward sloping line. But volatility is going up in bonds purely because of what's just happened today. There's going to be an argument over the next few weeks in the bond world of just exactly what is going on. Equities wise, have we had any effect? So the VIX today, low at 1878. I've had a high of 20.48, and we're now back into 19s. Well, we'll see how today plays out. We are starting to roll back, aren't we, in the US? Looking at it at the moment, just getting through those early orders. This could be the buying opportunity that I was talking about. There's going to be a lot of talking head speak flying through. I'd look to buy. If that goes down on the day for sure, you should be looking to get involved. So hence volatility staying a bit high on the day, because we are seeing we've seen up 1.5, down, now only up a half. But net, I think over the next few weeks through earnings, that I'm expecting that to come back into this 16, 18 region. Not been any questions for a while. Has everything blown up? Are we still recording? That's probably enough from me for now. So if you haven't got any other questions, I'll let you crack on with your trading. Thank you, Bletchley. Let's get back to this crazy data world. But it's going to give us extremes for sure. And keep your stakes low in this environment for the minute, because you have got some elevated volatility until we get a proper pattern. But I am looking for, like I say, equities to be the winner out of this. Be careful if you play bonds. If you play crypto, eventually that should break out too. You're in a liquidity environment, looser policy, and that will benefit from that backdrop. Look out for oil topping out, but we've got to keep an eye on what Iran does and Israel does. But I'd like to think that Iran are on the back foot with very little fundamental support for what they couldn't do. They haven't got the weapons probably to keep this as an ongoing thing. So I'd like to think that Israel will target some specific military things, leave oil alone. And as I said in the thing today, even though Iran has 3% of current output, OPEC have been cutting back. Remember, they can fill that void. The only issue for oil is whether they shut the Straits of Hormuz will cause issues in the region. But I don't think OPEC would be overly happy with that while they're not on top of the game. America are winning. They've got the supply ascendancy. So at the moment, strong oil price and low supply for OPEC is a win for US. So I wouldn't imagine Israel or Iran want to really mess up the that regional status quo. But well, you never know. Things have been slightly weird lately. And that's it. I don't want to keep going on. So I'll see you on Monday. Send any questions into the chat. Cheers.